So the stock market at all-time highs. We have electronic vehicles, meme stocks, stay-at-home stocks, COVID-19 stocks, all these things doubling, tripling, going to the moon. How do we safely land back on Earth? How do we take our moon-lit portfolio back to Earth from the roller coaster down to something a little bit more cruise-worthy? Well, today I'll look at two methods, that's right, two different methods to evaluate how you can get your portfolio back to Earth and earn some passive income by dividend investing. We're going to look at the aristocrats and Warren Buffett. Let's get to it. So if you want to get off that roller coaster, go into 2022 and create that passive income portfolio that you really want, hit the like button and let me know what you want to learn and gain from watching this video. For those of you who are watching this video, you probably know at least a little bit of what a dividend stock is. But for technical purposes and to make sure that you get the most you can out of this video, a dividend stock are companies that pay out regular dividends. Dividend stocks are usually well-established companies with a track record of distributing earnings back to shareholders. And just for the purpose of this video, I'm going to eliminate all non-US based companies and also things like REITs, MLPs, structured notes, any kind of those derivative products that pay in income or pay what they would call a synthetic dividend. So to figure out how to land in 2022, we're gonna have to find out what is changing, what things that we know of are coming in 2022. And there are probably three main things that are coming. The first one is rising rates. So as we know, the Fed, our friend at the Fed, Papa Powell, has given us a roadmap of what they kind of believe is what the interest rate environment will be moving on from 2022 and beyond. So why will the Fed increase interest rates in 2022 and beyond? Well, it's because of inflation. Inflation hit 6.8% in 2021. And what that does is it eats away those investment gains so that our real rate of return, or the adjusted, inflation adjusted rate of return, is going to be less because a lot of it got eaten up by inflation. And lastly, more of the same. COVID-19 is still here. We have the Omicron variant, many more variants suspected to come about since, we have rampant cases spreading right now. In fact, in Hawaii, I just checked yesterday, 1,400 cases is the rolling 7-day average. That's nuts. So back to dividend stocks. Why now, and what kind of dividend stocks should we be going for? Well, with inflation and rising rates, companies that are established businesses that pretty much already have all the infrastructure set up are good places to start. These companies won't have to go and find or finance new projects and take on new, potentially more expensive debt. These companies have a strong track record of paying dividends and are well established. Think of companies like Coca-Cola. They already pay out dividends and they are really well-known companies. But enough speculation and qualitative analysis. Let's take a look at the data. Well, just to give dividends a little bit more of a boost, from the 1930s, 40% of all of the market returns came from dividends. Second, during periods of high inflation, stocks that increased their dividends the most considerably outperformed the broad market on average, according to Fidelity. Dividend-paying stocks that have a regular scheduled dividend payment decrease the volatility of the asset and add to the total return so that your portfolio can remain relatively stable during any market condition. But wait, you might ask, COVID-19 is still here. What about all those wonderful tech stocks that are doing great, that are stay-at-home stocks, things like Zoom, Google, all those guys, aren't they beating everybody? Well, let's see. Jim Cramer, who is an ex-hedge fund manager and a host on CNBC's Mad Money, actually created what he calls the Cramer COVID-19 Index. It tracks about 100 different stocks that are, in his mind, said to do well because of COVID-19. These are things like tech companies, cloud computing companies, virtual sales tools, etc. I just wanted to throw it in there, but Jim Cramer, was diagnosed with COVID-19, or he was found positive with COVID-19 in December 20th. He actually has a picture of him showing one of those test kits that he has. Back to that COVID-19 index that Cramer created. Now, as you can see in this chart here, it has returned 8% over the course of 2021, while the SDY, which is the dividend-paying companies within the S&P 500, returned 18%. So it is beating out the COVID-19 index, so to speak, by about 10% for this year in 2021. All right, so we know now that even though we have COVID-19 and high inflation rates, dividend stocks are probably where we want to try and at least explore for 2022. Now, how do you find good dividend stocks? Well, the first, I guess, attractive metric is going to be something called dividend yield. As you can see here, dividend yield is relatively easy to find on various platforms. And what dividend yield tells us is during the course of a year, how much we're going to get paid based on the current stock price. For example, if you buy a stock that's $50 and every year you get an annual dividend of $1, that is an annual dividend yield of 2%. Do keep in mind though that if the stock price rises and the dividend amount doesn't, the dividend yield will decrease. What this looks like is, let's say that same stock you have appreciated by $10 to $60, but the dividend amount was still that $1 amount. If that's the case, then your dividend yield would have gone from 2% down to 1.66%. But the amount of income you get from that dividend notionally would not change. But before you go out and sell all your index funds and find the highest dividend yielding stock and putting all your money in there, not all dividend paying stocks are created equal. So here are some things that you need to look at before you go and buy up all of that one stock and trade all your ETFs for it, which I would never recommend doing. The first thing to look at is the earning payout ratio or the dividend payout ratio. What this tells us is how much of the net income a company receives goes toward paying for that dividend. Normally this number shouldn't be more than 50%, but it does change based on the industry and the sector that the investment or that the company is in. The next is free cash flow. This is basically similar to the first one, but it tells us how much cash the company actually receives after depreciation is kind of factored back in. Next is the net return on capital. What this tells us is how much money the company can make by taking on more money. Just kidding. Well, not really. So what this metric tells us qualitatively is if this company has a competitive advantage, which means that within their industry, they're able to invest $100 and pull out $110 after going through whatever process they're doing. This gives us insight on whether they can remain relevant in their industry, continue to grow, and continue, of course, paying that dividend. So now, finally, the fun part, pegging two different investment styles against each other. Now, I'm going to look at Warren Buffett and the Aristocrats Index. Warren Buffett, as you know, the wonderful Oracle of Omaha, he has his value investing pretty much down to a science. His fund returned over 2 million% from 1965, where the S&P only did about 23,000%. Pretty nuts, both sides. But it just shows you on how his strategy is definitely different from an indexing model. So how does Warren Buffett actually choose his investments? Well, he starts with evaluating a company based on his value investing philosophy. Buffett looks for companies that provide a good return on equity over many years, particularly when compared to rival companies in the same industry. Think why he probably invested in Coke versus Pepsi, why he invests in one major company in a specific industry versus the other. He looks for the competitive advantages there. Second, when looking for a great company to invest in, Buffett also reviews a company's profit margins to ensure they are healthy and growing. Buffett focuses on companies that provide a unique product or service that gives them a competitive advantage. He also focuses on companies that are undervalued that he can purchase at a good discount. So value investing in Warren Buffett's mind is he looks at a company and has his own kind of way of valuating them. And if by his own metric, the company is on sale or is trading at a discount, that's when he'll go in and buy. On the opposite side of the spectrum, the quantitative side, we look at the Aristocrats Index. And the Aristocrats Index is an S&P index that looks at the last 25 years of all the companies in the S&P 500 and pulls out those that have, throughout those 25 years, consistently been able to grow their dividend. In this index, all companies have an equal weighting. Therefore, no one company has more share of this ETF than any other. So how did they do against each other? Well, over the last 10 years, Warren Buffett, in this case, will use Berkshire, his company, and the one you can purchase as the peg, returned about 14% over the last 10 years annualized. The Aristocrats gave about 12.76%. Not bad. And the dividend on the SDY, or the Aristocrats Index, is about 2.65%, at least today it is. And of course, for this analysis, the dividends were reinvested, as Berkshire Hathaway does not actually pay a dividend. All the dividends that Berkshire Hathaway collects from these companies it's owned is reinvested into the system. So wait, Warren Buffett's stock doesn't pay any dividends. So how do I take advantage and get a dividend portfolio? Good question. So the top holdings of Berkshire Hathaway, most of them actually pay out a dividend. And I'll give you the top 5 just so that you can figure out, or just so you can see where his value investing can kind of take you. So the first one by holdings is going to be Apple. Apple, if you didn't know, pays a dividend. And you can see here's their dividend payout ratios with the stock price. Apple, over the 10-year period, has returned actually 30% with the dividends reinvested. Their dividend yield was relatively low at about 0.45% right now. Their stock price, though, is up at $180, so it's not that bad, especially if you bought it when it was like $19, as you can see in this example. Next on the list, we have Bank of America. Bank of America is a financial stock and they pay a dividend. Next is Kraft Holdings Company. That's like the ketchup. They also pay a dividend. Next is Verizon, they're a telecommunications company. They also pay a dividend. And of course, lastly, USB. Not the USB port, US Bank Corp. US Bank Corp also in the financials pays a dividend. Now, Warren Buffett does have about 25 stocks that he holds that do pay dividends, and you can go ahead and check the link down below if you want to learn more about those. But for now, these are his top 5. So a little bit devil's advocate here. Why would I pick my own stocks when I can just throw in money at a large index fund? And I would have to agree with you there. A lot of times, as you can see even in this chart here, the SDY didn't outperform the SPY, which is the S&P 500. So kind of ask yourself, well, what do you want to do? If your goal is passive income through dividends, then the SDY has a larger dividend yield than SPY. But if your goal is growth and you just want to put money in the stock market and pull it out 10, 20, 30 years in the future, maybe the SPY is a better choice for you. In closing, invest with purpose. We're all going to retire someday. Well, at least I hope someday to retire. And all that money is going to be used for something in the future. Right now, it could be very abstract or it could be very real if you're going to retire in the next few years. What I do know is that it's a great hedge against inflation, which we have a lot of right now, or at least people have been saying we have a lot of right now, even though maybe or maybe not, it's transitory. I know what I do is I put my money away in a Roth IRA, an index fund. I trade options from time to time because that's what I like to do. And I, of course, enjoy the journey. Anyway, whether this is a home run investment or just some other rotation from growth back to growth, be sure to check out my links to get up to $250 of free Bitcoin when you sign up using my BlockFi link. Webull is giving away 2 free stocks by opening an account and depositing $100. Make sure you check out those things. I post here every Tuesday, Thursday, sometimes a Monday and Friday, and I'll see you there in the next video.